want to just jump right into this, respect everybody's time. Thanks for doing this. We know you're busy. My name is Paul Hitchcock, if you don't know me, and I am with Barth Calderon. If you don't know us, we are an asset protection, estate planning, and business planning firm located here in Orange County, California, near Disneyland. We have about 12,000 clients across the country. We've been around for 30 plus years, 34 people at the firm, and we are very active out there with workshops across the country, education. Harry Barth is the founder and senior managing partner of the law firm, very respected across the country, in high demand for talks like this. So we're giving these talks everywhere to business groups, family groups, apartment associations. And we're going to get into it in 1 second here. I do want to mention that for everybody who takes the time to show up here, you can get one-on-one with the team. If you have questions about anything that comes up here today or other questions related to your planning, please take a minute. It's 100% complimentary. It can be a phone call or Zoom call with our team and attorney, and we get in and dig in with you on your planning. And the way you do that is I put a link in the chat there. If you click on that link, just give us your name, email, so we can get you booked on the calendar. I'm also going to show a QR code later after we get into this. You can snap a picture of the QR code to get in there. But yep, let's jump in.
Well, good morning, everybody, and welcome. I'm really excited to be with everybody this morning and talk about the one big, beautiful bill that was signed into law on July 4th of this year. And it's going to be interesting when we have our conversation together today, and it's just a tremendous amount of information for me to share with you, that it's not so much about what's in the bill as so much as it is about what's not within the bill and the vistas and the planning opportunities that we have. I'm going to try to take a dive that is understandable, relatable, and hopefully helpful to each and every one of you attending today. But I have to have a little bit of a disclaimer first, and the disclaimer is please understand that what we're going to talk about today is not meant to be political in any way, shape, or form. There's no political bias in any way. But unfortunately, in the United States of America today, tax policy has been very influenced by politics. And that becomes very important for us today to understand because of the planning vista that we have can be impacted by political action in Washington. So I'm not advocating one or another, just giving you the way it is and what we can do under the law as it stands today. So the purpose is for me today to go through with you the things in the big, beautiful bill that impact our constituency. We're not going to talk so much about the credits for seniors, the tax on tip, no tax on tips, and no tax on overtime and or the interest deduction for a car. I think we all understand what those things are. We're going to talk about the estate tax and income tax implications, which are quite significant under the law. Now, let's talk about permanency. So, one of the things that came about in the big, beautiful bill is the fact that the estate tax and gift tax exemptions, which were due to expire at the end of December 2025, and drop down to about $14 million, have now been renewed on a permanent basis. And at the end of this year, will be $15 million a person, $30 million a couple for both estate and gift tax exemptions. And they're made permanent. But I want to talk a little bit about permanency because it has a lot to do with our planning vistas today. Permanent in Washington speak is until the next Congress changes it. And I think that's very, very important to understand. The goals and aspirations of the big new bill, as I'm giving to understand them, is a trickle-down effect. Hopefully, it'll improve revenues, it'll improve tax situations, it'll improve our country economically. But if that does not happen, all right, which could very well be, there'll be a political shift or an economic shift. And in that shift, we get to a scenario where what once was permanent is not permanent. So, and they can make a change. And there's always been, you have to have some understanding as well before we dig into specifics of what the estate tax was all about. The estate tax has never really been about collecting revenue for the government. The estate tax and gift tax systems have been imposed for the purpose of not allowing wealth to concentrate in the hands of a few number of families. So it is a generational wealth consideration and not so much an income consideration. Given the fact that it's philosophical in that respect, it's changed dramatically 4, 5, 6, 7 times just in our own lifetimes. And I'm fully expecting that it will shift again, even though we have this level of permanency. Now, given that, there are a number of opportunities that are available to us as a result of the Big Beautiful Bill that I'll share with you today. And it's in my opinion that we are now in the best planning window that we have ever seen in our lifetimes. And there's a lot of reasons for that, and we'll talk about that this morning. Planning in the area that we're dealing with today is not static, it's dynamic, and it's all about generational wealth transfer. However, today we're also going to put in some various different income tax aspirations. So let's talk a little bit. We'll talk about a tax trifecta trust. We'll talk about other things that are involved in consideration. But let's deal with some very, very basic planning. So, and we'll start some of the basics with basic estate planning and how it's impacted by the bill. And I would think that in the vast majority of cases, almost universally in all cases, trusts that we have created and others have created over the last 15, 20 years need to be looked at for possible changes. And let's understand why that may be. So, for many, many, many years, the estate tax exemptions were $5 million, $4 million, $3.5 million. There was 40% tax, 50% tax that's involved. So we always work really, really hard to turn around in our estate plans and make sure that we were able to take maximum advantage of the estate tax exemptions that existed at that time. So, for many of you, you'll remember over the years, and if you look at the estate plans and the trusts that were done, they were traditionally done when we had a reasonable amount of net worth with a trust A, known as a survivor's trust, a trust B, known as a credit shelter trust, a bypass trust, a non marital trust, and a trust C, known as a marital trust, sometimes known as a Q tip trust. And the purpose for all of those trusts were not only from a control issue, but from a tax issue to make sure that we were able to utilize the existing exemption, the $5 million or the $3.5 million at that time in the B trust. And very importantly, to have the growth of the B trust to be exempt from taxation. So if we filled up the B trust with $4 or $5 million worth of assets on the death of one spouse or on the death, then the assets in that B trust grew significantly upon the second death, there would be no estate taxation. Now, when we're dealing with a 15 to $30 million estate tax exemption threshold, we are dealing with a very different scenario. Very few families are going to be impacted currently by the tax. And the estate plans mandate it upon death a split of an A to a B trust. One of the things that we have to be concerned about is that the B trust, the assets that have made it into the B trust that will in the future be exempt from estate taxes, will no longer receive a step up in basis. Now, let me explain what that is. So basically, if we put assets into the B trust that are worth $5 million, and that B trust grows to $10 million, and someone someone dies in the B trust, and that B trust assets are inherited by the next generation, they sell those assets. That basis is 5 million, and they have to pay capital gains tax on the growth inside the B trust. Had the assets been outside the B trust, when that person died, that that same asset that went from 5 million to 10 million under current law would get a new step up in basis. So the full 10 million would avoid both state and federal capital gains tax. Now, in some cases, that's worth $1.5 million. Now, if we have $15 million of exemptions or $30 million worth of exemptions and we never get there, well, guess what? We never needed a B trust. And yet we were mandating a B trust in all of our estate plans almost universally. So I think it's a great time to think that maybe we should revisit our estate plans and take a look and say, well, maybe we should have an AC trust, which creates an irrevocable trust for a surviving spouse. It creates asset protection for the surviving spouse and allows us to do generational planning for the next generation and still get a step up in basis. So if we're at $10 million or $12 million worth of net worth, I think it's very important to revisit the way our estate plans are constructed to take advantage of the scenarios that we have now. Of course, remember my point about permanency. And so, one of the things that we want to talk about with the increased gift and estate tax exemptions that we're looking at, and hopefully they'll stay and they'll grow, and they're supposedly indexed for inflation, which I think is quite important. There are some other things that we did or in our structuring that may not be warranted anymore. So, let's talk about that while we're talking about basis. So over the years, for many of our clients, not for all of our clients, depending upon the size of the value of their net worth, one of the big things that still remain, remember I said it's not what's in the bill, it's what's not in the bill. One of the things that have been under attack for many, many, many years is the use of valuation discounts. Let me talk about what valuation discounts are for if you just don't know. It's kind of voodoo math. So what happens is that depending upon the nature of the asset and the way it's structured, an asset that may be worth $10 million of fair market value, all right, or $5 million of fair market value, when held in an appropriate entity with appropriate restrictions, that $10 million asset could be valued for $7 million for estate and gift tax purposes. Now, that's a 30% reduction in that value, and alone would save $1.2 million worth of taxes. For many, many years, intra-family discounts and discounts of that nature have been significantly under attack. And in the big blue bill, in the big beautiful bill, not blue bill, the big beautiful bill, um, they're okay. We still have all the intra-family discounts. The question is, in the bill, is do we need them or do we want them? So we've constructed LLCs and limited partnerships and minority ownership interests in order to achieve the maximum discount. But now watch this. Here's a change. If we have a $10 million asset that with discounts is valued at $7 million, so we would have saved 40% estate tax on that $3 million, which is $1.2 million. But if we have a $15 million exemption and $10 million worth of assets, there is no estate tax. However, if the discounts are applied, and they're applied, then what happens is the basis that's inherited by the next generation, my kids get a basis of $7 million. So when they sell that property for 10 million or 11 million, they have capital gains for 4 million. It might have been better to revisit that structuring again and say, well, maybe we don't want the discounts. Maybe we want the higher value because it creates a greater value for step up in basis for the next generation. This is something when we're dealing with a $15 to $30 million estate tax exemption that we didn't really look at in the past. So the big, beautiful bill brings along with it a significant amount of complexities that go along with that. We also know that in the big, beautiful bill, that planning that we do today, the vistas that we have open for us today, should the law change in the future, is significantly not going to be clawed back. So we can have this great opportunity to deal with that. So There are trusts called intentionally defective grantor trusts that we were worried about. Maybe they would go away. What did it do? It allowed us to sell assets to a trust, take back a promissory note, and have appreciating assets grow in the estate of the next generation and freezing the value in our generation. So if I had a $10 million worth of appreciating assets, I sold them to this trust, took without any income taxes, by the way, and took back a $10 million note. The note in my estate is frozen. Note's not going to grow, but the $10 million worth of real property, stock, other assets, and businesses may grow in that trust and move that to the next generation. We still have the availability to do that planning. That was under attack. We have the availability or continued availability to engage and use non-reciprocal spousal lifetime access trusts to lock in the 15 or $30 million exemptions today because we are not sure, no matter how permanent they call it, that these exemptions will remain in the future. They're the largest in history. And we can do that in a way that we have still a reasonable amount of control by the surviving spouses and the utilization of the assets and have all the growth moved to the next generation. The utilization of grantor trusts and domestic asset protection trusts, all unscathed in the big, beautiful bill. Okay. Now, given that, we still have discounts available when they're available. We still have the trusts. We have grantor annuity trusts that are available and still available for us as a result of the big new bill. But we have a few other things that are available called upstream planning. Let's talk about upstream planning. This is kind of interesting. So now not only did we get the $15 million a person, but maybe our parents also got the $15 million a person, mom and dad, or grandparents have $15 million a person. They don't have any money, but they do have $15 million a person exemption. So, what would happen if we had an asset that had a low basis, we paid $1 million for, and now that asset is worth $12 million? And so, what would happen if we gifted that $12 million asset to our grandparents or our parents, and then who are elderly and may have, more likely than not, will pass before we do? Terrible to think about, but true. And then we inherited it back from them with a complete step up in basis. So that $12 million property that comes back to us with a $12 million basis as we got it from the parents or the grandparents has now saved us close to $3 million worth of taxes. This is known as upstream planning. So we have to remember that not only do we have 15 million, our parents have 15 million, our brothers have 15 million, our grandparents have 15 million, and through the utilization of lateral and upstream planning, we may be able to get a tremendous income tax benefit in the right circumstances with the right level of sophisticated trusts. So, asset classes to consider for that: closely held businesses can move up and down, real estate with appreciation can move up and down, cryptocurrency can move up and down. So, there is a lot of opportunity there in upstream planning as a result of having the larger exemptions that are currently available to us. Now, there are a few other things that I want to talk about that I think are also significantly important, and that is the big beautiful one big beautiful bill um, gives us an opportunity in a few other areas. So we have all the estate and gift tax, and the point that I'm trying to make here to each and every one of you, I really think it's a great time to do some planning, look at some of the basic trust work that's been done over the years, some of the entity work that's done over the years. Again, repeating, looking to whether or not valuation discounts are important or not for us, whether or not B trusts are important or not important to us, and to capitalize on the tools that we currently have while we're in this great vista. But let me move forward a little bit further into some of the other interesting opportunities that arise. So one of the interesting opportunities that arise is in the big beautiful bill, we have been I would say a great improvement in what is known as qualified small business stock exemption. And to put it simply, if we're starting a new business, brand new business, um, that whether it be a technology, manufacturing, not a service business, technology, manufacturing type of business, and we plan on building that business up for a number of years, 3 years, 4 years, 5 years, and then hopefully sell the stock to some acquirer along the way. Well, we can sell that we can sell our original issue C corporation stock, and we can now we used to be able to sell and get up to $10 million if we held it 5 years to get $10 million of that sale tax free. Whoa, that's interesting. And some of the things that happens now is in the big beautiful bill. The amount that I believe that we can now go tax free is $15 million. And if we hold it only 3 years, we get 50%. After about 4 or 5 years, we get 75%. And after 5 years, we still can get up to $10 million of exempt status. So that means maybe now we should be taking a look at when we're forming a new entity. Maybe that entity has to be formed as a C corporation in order for this to happen. Should be formed as a C corporation. Now, for those of you that have listened to us over the years, holding C corporation stock has not always been the greatest thing from an asset protection perspective because we get a liability, creditor comes in, takes our stock, seals our company. But we can have that C corporation stock held by an appropriately and properly designed LLC and get the asset protection. And now we could do a few other things too. How about when I started this company that's going to develop a new app or new software, I had a percentage of the stock, 50% of the stock owned by me, and I had um, 25% of the stock owned by my son, 25% of the stock owned by my daughter. All right. So now it's 50, 25, 25. All right. And I structured those daughter and son ownerships into something that we're going to talk about in a minute, into non-grantor trust. And I think we're going to see the rebirth of non-grantor trusts. Every one of us gets the $15 million exemption. So I have 15 million. My daughter has 15 million. My son has 15 million. So in essence, by stacking that, we can almost sell our business and get $45 million worth of sale without any federal income tax whatsoever. So we have the ability now through the use of non-grantor trusts to expand the utilization of some of the things that have been improved under the big and beautiful bill. So let's talk a little bit about non-grantor trust, and let's all talk a little bit about SALT exemptions. So many of you have read that the SALT exemption is back to some degree. That's the state and local income tax exemption that we can now deduct on our federal income tax, depending upon our family's income. It gets kind of starts to get diminished at about $500,000 of adjusted gross income. But that allows me to deduct, if I was less than $500,000 of income, up to $40,000 of state and local taxes against my tax return, which is a pretty nice tax benefit. However, guess what? With the proper utilization of non-grantor trusts, which I'm going to define for you in a moment, every one of those trusts also gets a $40,000 SALT exemption under the big beautiful bill. So therefore, if I have given a piece of real estate that has state and local taxes associated with the revenue associated with it, and it's taxed to that trust, I can get another $40,000, and that trust doesn't have over $500,000 income. I can get another $40,000 exemption, and then another $40,000 exemption. So what this is telling us that in our consideration here is that in we'll call it the construction of a non-grantor trust. So first I need to define what a grantor trust is and then a non-grantor trust. So under the law, we have basically two ways of taxing trusts. One of which I create a trust for, the benefit of my kids or my spouse, and I am the one, the grantor. I created it, and I'm the one that pays the income tax on that. So inherently, all the interest, dividends, and gains on that particular trust is paid for by me. Which is, it may sound convoluted, but it's not a bad idea because that allows that trust to grow unimpaired by taxation. And it also allows me, by paying those taxes, which, by the way, for some reason, odd reason, is not considered a gift, to lower my estate. So I'm lowering my estate on one side, enhancing the value of my children's estate or my heirs' estate on the other side through the use of a grantor trust. And the amount of tax that I'm paying on behalf of them is not considered to be a gift. Just a wonderful opportunity. But now we also have the opportunity to create new taxpayers. So with proper structuring, we can create trusts now which are non-grantor trusts, meaning that the income tax is is going to be taxed at the beneficiary's level of the trust or to the trust itself. And when it's taxed to the trust itself is an additional taxpayer. So it gets more of that qualified small business stock. It gets more of the $40,000 SALT deductions. It also could possibly lower my income because I'm shifting income now from my tax bracket into beneficiaries' lower tax brackets. And by shifting, so that's another trifecta. You know, instead of my at the highest tax bracket, I've now shifted income to my children who may be in a lower tax bracket than me. Some pretty nifty planning. But it does something else for us. For those of you that are eligible for the qualified business income pass through that's available to us, it's now made permanent, permanent as the permanent goes, at about 20% of pass through income. That also begins to phase out for many of us in the medical or legal business and other businesses as our incomes begin to rise. By diversifying our income amongst other lower earning family members, we may be able to bring our income thresholds down to the point that we now begin to qualify for pass through benefits that we were unable to take advantage of before. So that's another thing. So we're looking at potentially the rebirth of C corporations. We're looking potentially at non-grantor trusts because for state taxes, for many of you, that opportunity, we don't have to worry about it anymore. We're not near that $30 million or that $15 million. So now we could use our trust work to see how we can save income taxes for each and every one of you. Now, there's something else that happened in the new big and beautiful bill. Is not, again, not what is, it's what isn't. We didn't get the income tax hikes that would have happened if everything phased out, but we did get a return to qualified opportunity zone investments. Now, let me tell you a little bit about qualified opportunity zone investments that have now basically been enhanced and restated under the new One Big Beautiful Act. So we now have an opportunity. This begins, by the way, and we'll talk about planning opportunity here in January of 2027. So we still have to get through the balance of 2025 and through 2026. That we would be allowed to turn around, and if we had a capital event, sold a business, sold a house, just have a capital gain of any form, we would have the ability within 180 days of the time of doing that to defer that gain, into qualified opportunity zone investments for up to, well, I'll explain it, 5 years. So for 5 years, we have the utilization of that money that would have ordinarily gone out for capital gains taxes. So if I had a $1 million capital gain in 2027 and I wanted to defer $500,000 of that gain, I could defer it out for 5 years. And then, interestingly enough, depending upon the nature of the qualified opportunity zone investment, at the end of the fifth year, I have to pay the capital gains tax on that because I was able to defer it for 5 years, which is free use of money for 5 years. But for whatever reason, which we love, the federal government will reduce the amount of capital gains tax that I have to pay in the fifth year by 10%. So if I had $1 million gain that I deferred out 5 years, now I only have to pay capital gains tax on 900,000. It's a freebie. We take that. And then if I continue to hold that investment until the 10th year from the time that I did it, all the gain on that investment that I have upon sale would be completely tax-free. Now, this is not California, this is federal. And this is a great opportunity. It was a wonderful program. Now, there is an addition to this one, which is not very well understood yet as it's completely spanking brand new. If the qualified opportunity zone, all right, that's being considered um, is a rural opportunity zone, so there's some definition of what rural areas are. In the fifth year, the federal government will reduce our capital gains tax by 30%. So if I had $1 million capital gain, it's deferred in a rural qualified opportunity zone investment for 5 years. In the fifth year, I would pay my capital gains tax based on $700,000 and then hold on to it till 10 and have everything become completely tax free. So one of the things that we need to think about and come as a result of today's workshop and seminar is what do we do in 2026? And how does that apply to us? Well, in structuring equity events, perhaps in 2026, maybe we start to consider a couple of different opportunities. One opportunity would be to turn around and do a installment sale. Take a small down payment in 2026, recognize the capital gain on 2026, the small down payment, and get the bulk of the capital gain second in 2027, and then defer as much of it that we wish, if at all, into qualified economic opportunity zone investments. The other thing that didn't happen, 1031 exchanges for real property were left unscathed as a result of the big and beautiful bill. So the big beautiful bill uh, inherently gives us the opportunity to create new taxpayers through the use of non-grantor trusts. And the same non-grantor trust will also provide for us significant asset protection, which I think is critically important. We have to understand that permanence, all right, is not permanent when it comes to dealing with governments in any way, shape, or form. Now, some of the things that we should just briefly mention is to understand that the no tax on tips is basically just for 4 years. The no tax on overtime is for 4 years. And there are different complications that come along with that. I think it's important to understand for those people, kids and others that may be impacted by that aspect of the One Beautiful Bill. Now, the One Beautiful Bill also turns around and deals with an exemption for seniors that is highly complex. They phase out very easily. School teachers, have some special exemptions. Why they single them out, I don't know. I'm glad for the school teachers, but it's not necessarily for us. So we have the understanding that the Big Beautiful Bill singles out various industries for favor, while other industries are not singled out for favor. But in general, it should be much more favorable for most of us in lots of different areas. One other area, I don't mean to jump around a little bit, but I want to get back for in the structuring before of general partnerships with limited partnerships and limited liability companies. For many cases, for the senior generational level, we did less than 50%, owned by the senior level, and a greater than 50% owned by the second level, the children or the grandchildren, in order to again gain greater discounts. Maybe those discounts are no longer necessary. Maybe we could turn around and keep more control at the other end under the big beautiful bill. So the planning environment is highly situational in getting that done. So, there's not much more that we need to say today about this, that other than I want to just maybe one other spot I want to jump in on a little bit, and that's the enhancement to 529 plans.
Hmm.
And of course, we've all heard about there are Trump accounts where we can put up to $5,000 a year in Trump accounts, and the government may give us $1,000 towards that's basically an IRA and a saving for children that have to be started after age 8, but can't be touched until age 18. The more to come on that, on where the utilization of Trump accounts. And in the 529 plans, which many of us are used to provide for children and grandchildren's education, which have always been wonderful, that's now expanded that we can use that to pay for private school, K through 12, um,
Wow.
which we weren't necessarily able to do before. And we were also able to use $529 for credentialing. So if someone goes on to get a credential, whether it be a physical therapy credential or a professional credential, that is now allowed to be paid for out of a 529 plan. There are also some expansions on ABLE accounts. We could talk about some things that have basically been eliminated. So most of the clean air, climate types of things, whatever their reasons are, have been eliminated. So we don't see a lot of basis for that any longer. Our deductions for oil and gas, very important for us for income tax purposes, have remained and remain the same under the big beautiful bill. Home mortgage interest, it's very clear now only original purchase home mortgage interest is deductible and no more than $750,000 on a loan. And home equity lines of credit are not deductible any longer for interest in that particular area. We also have an opportunity, but all pretty much phased out by income. However, if we bought a car and we financed the car and the car was assembled in America, up to $10,000 of interest can be deductible in getting that done. But most of those smaller deductions don't pretty much impact all of the people in our particular constituency. We
Harry, I got a
all,
couple of quick questions. You want me to
sure,
address those?
sure.
Yeah, someone's saying, not sure if they missed it, but did you mention issues with Medicaid, long-term care issues, gifting assets to parents, grandparents?
Yeah, we didn't. We did. I did not mention Medicaid or long-term care issues. I don't think that. I don't think anything with the big beautiful bill had any modifications or changes to that. Most of that is with on a state-by-state basis. I think that in the Medicare changes, the concern would be there that if we were going upstream with assets in order to inherit those assets from parents in order to get a step up in basis, if those parents were concerned or had Medicaid, a welfare type benefit medical plan, that would not be in the best way to do that. So that was a good question in that respect.
What about the HELOC, saying clarification is no longer deductible, even
Yeah,
if it's used for a purchase of another property or home improvement?
that's correct. Basically it's that home equity lines of credit are no longer interested, are no longer deductible. Purchasing another property never was um, used for home improvement. It's now just bound down to the original purchase price for a home.
Okay, and then someone else, I own, David, thanks. I own 100% of an S Corp and considering a switch to C, my current stock does not qualify for QSBS. Can a new entity be created at time of S to C and allow new stock to be issued to Sun and Trust and qualify for QSBS?
I think the answer to that is absolutely yes.
Okay.
New issued stock for a new business. Yes, it'll be considered to be a new business. I think we could plan around that and make that work.
Okay. Harry, I just want to show this real quick. Want to get this up here on the screen. So if you snap that, it's coming up. Harry, can you see the QR?
Not yet, no.
All right. Uh, should be up in a second there.
There we go.
All right. So if you snap that, that gets you one-on-one with the team and attorney. I just want to make sure you have that. I did put a link in the chat also. And again, this is 100% complimentary. Get on there. We can do a Zoom or a phone call, dig in, get a lot of questions answered, and tell you how we work and so forth. So there's the QR code there.
Right. And let me just close with one other thing, and that's the one big beautiful bill's impact on life insurance. And many people have established irrevocable life insurance trusts to help pay for estate taxes that come with a lot of restrictions associated with it, with the utilization of cash values. Still good for asset protection, but may no longer, if may no longer need to be in an irrevocable or second to die policies that could be repurposed for other purposes. I think it's a good time to take a look at that, because we bought it for a liability that we may no longer have. But there is this one admonition. I hate to be repetitive over and over and over again. I've been at this for very long time, 45 some odd years, and I don't like the term permanent because I'm not sure of its permanence in our political scene. Therefore, again, my admonition to each and every one of you this morning is great planning time, great planning window. We don't have a gun to our heads. I have all the tools in our tool belt to help you move wealth from one generation to the next, and we're excited to help you do so. And with that, Paul,
Here,
unless there are any
couple
other
couple last
questions,
things. Yeah, a couple last
sure.
things. The non-grantor trust paying the SALT. So does that eat up the SALT deduction from the beneficiary? Say I own a home that has 40K property tax and they also own a home with that much tax. So that means essentially both of us won't benefit?
Yeah, well, when you create the non-grantor trust, the non-grantor trust gets the ability to deduct the $40,000 of SALT exemptions along the way. It's a trust level deduction.
Okay. Please excuse my ignorance, is what they're saying. What is the HELOC not deductible from? I'm in the process of refinancing a
It's
few
not the deduct,
properties.
it's the interest on the HELOC.
Okay. Uh, she's pulling, she's doing a cash out. Is there anything she needs to know about the funds that will come out of those refis?
No,
Okay. Okay. Uh,
it says, let me just quote for everybody. It says the OBBBA permanently restricts the ability to deduct interest on home equity loans.
got it. Okay. All right. If there's no, you're welcome. You're welcome for that answer. We're going to thank you. All right. If there's no further questions, we have recorded this. Look for your email. We're sending out the replay. And again, you got more questions, get with us, sign up, use the QR code. Last question. What if it is used to improve the home?
To the best of my knowledge, no home improvement, no interest on that is any longer deductible.
Got it. Okay. Harry, fantastic.
Thank you,
Thank
guys.
you.
It was all great to be with everybody. We look forward to answering questions and taking care of you. Thank you.
Thanks.
Bye.